All right, so in this series that I'm going to start for you guys, this supply and demand universal strategy series, this is probably your last stop for supply and demand, figuring out how to trade supply and demand, just everything you need to know about how to trade with it. I mean, I put so much effort into this series, into the research. I mean, it is crazy the amount of hours that I have put in for you guys. And I did it because I didn't want it to be like a crappy, half done, somewhat decent, series with a few little presentations of a few little examples here and there. Like, no. This is the supply and demand universal strategy that you can use on anything that you want. I mean, I go through everything that I've learned, everything that I've known, and I even included some trading models that I personally use and have used in the past, and I'm giving it to you guys for free. You guys don't have to pay a cent. The only thing you have to do is like and subscribe, comment, and just show me some love. Okay, this is everything that you would normally have to pay for a course. All right, so pay close attention, go through everything carefully, and I promise you, you will become a profitable trader by watching, learning, and practicing. Okay, and as always, this is not financial advice. This is strictly for educational purposes. So without further ado, let's begin. So why trade supply and demand? Number one being simplicity. The concept of supply and demand is straightforward and intuitive. When the demand for an asset exceeds its supply, price tends to rise. Conversely, when supply exceeds demand, price tends to fall. This simplicity can make the strategy easier to understand and implement than some other trading strategies. Number two is versatility. Supply and demand levels can be identified in any market, whether it's stocks, Forex, commodities, or cryptocurrencies. And I mean, this applies to any market, even futures, whatever. This makes the strategy versatile and applicable to a wide range of trading scenarios and strategies such as different time frames, swing trading, scalping, etc. Lastly, risk management. Supply and demand zones can provide clear entry and exit points for trades, which can help in managing risk. For example, a trader might set a stop loss just outside supply or demand zone to limit potential losses if the market doesn't move in the expected direction. So, ladies and gentlemen, supply and demand is probably the most versatile, and I would even say used whether people realize it or not. Even when it comes to ICT concepts, there's in one way, shape, or form supply and demand is factored into it. They probably just label it or call it something else. But the point is, supply and demand can really and truly be used in any market or in any trading scenario. Now, some of the more interesting slides, right? So how do time frames factor in? You can trade with supply and demand on a single time frame or combine multiple time frames, but don't use more than 3. Generally, that is a rule I keep, but you can use as many as you want. But again, personally, I don't use more than 3 combined time frames. Ultimately, choose what works best for you. But if you do decide to use multiple time frames, here's a few ways that you can use them. One being, you can use different time frames to refine your points of interest or a fair value gap, an order block, whatever the case may be, right? Those would generally be called points of interest. Next would be finding direction, right? So if you're trying to find direction of where price is headed, finding the direction of the market, you can use multiple time frames or even a single time frame, right, to find the direction of where price is going, whether it's for the day, the week, or the month. Next is finding more confluences. You can go on different time frames to look for more points of interest, look for more entries, look for whatever it is that your confluences are for the day or for the week by using multiple time frames. And lastly, you can use bigger or find bigger take profits. So for instance, if you are scalping on, let's say, a lower time frame, but you might be targeting an order block on a much higher time frame, so you would hold your trades for a little longer, but you get in at a really good discount or premium. Now, some commonly used time frames is the 1 minute, 3 minute, 5 minute, 15 minute, 30 minute, 1 hour, 2 hour, yes, 2 hour, surprisingly, 4 hour, 8 hour, 12 hour, daily, weekly, and monthly. Now, you can use any time frame you want or that has suited you in the past and with a proper trading plan, and just make sure you've back tested your strategy with that specific time frame. You don't just want to use a random time frame if you don't know what you're doing. Okay, now for scalping / intraday, when using these time frames, more confluences can be helpful. Furthermore, when doing your technical analysis on these time frames, a 2-week view of price is generally recommended. That's when using anything from the 1 minute up to the 15 minute, right? But again, you can use whatever time frames you want as long as it's around this range or even further down, right? So let's say you're on the seconds time frame, you can definitely use a 2-week view. Generally, that's what I recommend. Now, as for swing trading, you can use higher time frames since they require less entry confluences. Now, you'll see what I mean later on down the slides or in the series. I will give you some examples of how you can use higher time frames and how they require less entry confluences. Anything from the 30 minute to the daily time frame can be used for swing trading. Now, the 4 hour. The 4 hour is very commonly used for basically anything, such as market direction, points of interest, profit targets, finding a draw on liquidity, etc. The 4 hour, I don't know if you've noticed this, but if you've bought, let's say, a random mentor's course on supply and demand, you'll notice that at some point in their lectures or strategy, they will use the 4 hour time frame. It's a very commonly used time frame. They combine it with literally almost anything. I love using the 4 hour time frame, and you'll even see me use it when I use my weekly market overviews. And if you haven't checked one out, I recently uploaded one on my live for YouTube and Rumble, as well as X, so follow me on all three. Now, the 30 minute and down. Keep in mind that fair value gaps are actively reacted off of when trading from the 30 minute and below. Traders also like to use entry models when relying solely on these time frames. So when using the 30 minute and lower, you'll notice that price tends to miss order blocks and react off of fair value gaps more often than not. Why? There's so many reasons for that, but generally that is something I've noticed, and I've even noticed in other people's trading, right? So I will show you how you can try to at least mitigate those lost entries later down the series. But just keep in mind that when trading on these time frames and lower, fair value gaps are more active than order blocks, more than anything. Okay, now when I talk about entry models being used more commonly on lower time frames, you'll see what I mean in these next few slides. But entry models seem to do a little bit better when it comes to strictly only trading on the 30 minute and lower rather than the higher time frames. Why? I don't know. That's just what I have personally seen. Maybe you've seen it a little different. Maybe you've seen entry models work on higher time frames rather than lower time frames, right? It's up to you and how you trade and how you're able to see and identify the market. But in my opinion, I have personally seen entry models do a lot better from the 30 minute and below. Now, this is actually a question I used to have when I first started trading, especially when it came to supply and demand. So, do kill zones apply? You don't have to use kill zones, but they can be a great confluence when making a strategy, since it can make price more predictable, plus it carries great price volatility in your favor. Kill zones can be used to measure how much time you want to trade for your session, or day, which can help create a more strict trading plan. So no, you don't need kill zones when it comes to trading supply and demand. But like I said, they can be a great confluence, and you'll see in one of my trading models that I'll show you later on down the series how I use kill zones to take my trades or my entries. Okay, so just be ready for that. Now, is Elliott wave necessary? No, but understanding how the Elliott wave theory works can be beneficial, particularly if you're interested in timing the market or creating a personalized trading plan or trading strategy. While it's not mandatory to grasp every detail of the theory, having a basic understanding can certainly be advantageous. It's worth considering diving into Elliott wave to enhance your trading knowledge and potentially improve your trading decisions. Now, when I talk about timing the market, I mean there are ways that Elliott wave really does time the market. Why? Because it's telling you that there's certain waves and there's a certain length to these waves, and there's waves inside of waves, right? I will show you a quick example of what I mean by that, actually, because I actually have been using it lately, trying to see how I could incorporate it, and so far it's been doing pretty good. So let's actually jump on the chart real quick. Okay, so as you can see, I've already drawn up my Elliott wave legs, right? And according to the legs, each wave, and I'm not an expert on Elliott wave, as a matter of fact, let me make this very clear. I'm just now getting into it. So don't take my word for every single little thing I say. I'm just learning, but you can see why it's very useful. But like I said, each wave is basically telling you or predicting where price is going to go. Now, here, the last wave ended. According to this pattern, price should go down, right? Which it did. And if you go on a, let's say, lower time frame, we'll go on the 15 because I love the 15. You can see price reacted perfectly from these supply areas, right? So what I could have done is I could have entered limit order style or with a candle, right? And what could I have done? I could have targeted this set of liquidity first and catch those big risk to reward trades, right? So that's one way that you could use Elliott wave. So if you're someone that's been thinking about trading with Elliott wave, or maybe looking into it and maybe thought, man, it's a waste of time, I can assure you it's not. It's a very interesting theory, and I think it could be highly used on basically anything that you do. And I recommend drawing your waves from the 8-hour and up, and then dropping down to a lower time frame. That's how I've been using it. From the lower time frame, I strictly trade supply and demand, or anything that I see worth kicking in with. But generally, that is how I use Elliott wave. Alrighty, so now we have volumized order blocks. So very simple, bearish order blocks with more bearish volume means buyers are exhausted at that level and can be considered as a stronger order block. Bullish order blocks with more bullish volume, sellers are exhausted at that level and can be considered as a stronger order block. So I'm going to show you real quick how that looks like on the charts and why that can be very important. Okay, so as you can see, I am using an indicator that I have already added onto the presentation that you guys can download. But if you want to copy my settings, here they are. Just pause the video, copy what I have. Now, as you can see, this is a great way of choosing which order blocks to buy or sell from. And just to prove it to you, obviously I cherry picked this example, but I just want to show you the power of these kind of order blocks, right? So as you can see, price was going up, tapped in to that very bearish order block. Price is melting, it's going down, it's tapping into this bullish order block, and you notice that when it tapped in and quickly rejected up a little bit, but eventually came down because there was so much volume up here that price just decided to keep melting, and price will keep doing the same thing, going along with the trend. Now, obviously, you can keep buying and selling as long as you're doing it with the proper price action models, or if you're really good at reading price itself, you'll know when to enter and the appropriate order blocks. All right, so we're just going to keep letting price play out just so you can see how it reacts. But as you can see, it's an amazing tool, an amazing way to trade, right? Because it's basically almost giving you a sure way of trading. Like, look at that. You saw how price reacted off of that pretty strong order block. I mean, there's all this bullish volume right here, right? And what did price do as soon as it tapped into it? Check it out. Taps into it perfectly and starts heading the other way. I mean, it's almost like a buy and sell indicator. Obviously, don't just buy and sell randomly. Like I said, make sure you're reading price action, make sure you're reading everything, and that it's with your trading plan. But I'm just saying, it's an amazing concept that I wish I would have learned and known a long time ago. So check it out on the charts, do a little bit of back testing, and just see how it works for you. Okay. Now I want to talk about something that I guess, I don't know if you could say I came up with, but this is something that I decided to name for myself, and it's called dual frame blocks. So these are order blocks that, when zoomed on a lower time frame, they contain imbalances and can make these order blocks more valuable, especially if you don't see any imbalances on the current time frame that you initially spotted them on. Now, there might be times where, I don't know if you've noticed, but some order blocks or sometimes price will react off of a certain level or order block, and you'll say, why did it react off of that? There's no imbalance near that order block, but for some reason price still came down there and decided to touch it, right? Well, that's because there was probably some kind of imbalance or even liquidity inside that order block that price decided to come down and take before heading up. Now, I've added a little quick example here. So in the 5-minute, there's these two imbalances, but on the 15-minute, the whole order block, you aren't able to see it, right? It's just the order block itself. But like I said, if you zoom in on the lower time frame, on the 5-minute, there's this small imbalance here and this small imbalance here, and I just marked the gap here on this order block, so that way you'll know this is part of the illustration. But yeah, definitely something very interesting, something that you should check out. See if you can spot that on your charts. And like I said, this is on any time frame. You can find this on any time frame. Highlight an order block, zoom into it, and I promise you, you'll probably find something very interesting inside those order blocks. All right, so internal and external liquidity. Now, before moving on, I want you to make sure that you watch my liquidity and inducement video. It is extremely vital that you watch it before continuing on. You do not know how important it is to watch that video, because I need you to have a really good grasp and understanding on liquidity before doing anything else. Please understand how liquidity and inducement works. You're going to have a very hard time trading if you don't understand it. So without further ado, let's continue. So for internal liquidity, it's essentially price being created inside a range or a trend range, and then finally gets taken out once price touches our demand or supply zone. And then for external liquidity, it's essentially price that is being created but without being taken out on the outside of our trend range. But once price taps into our demand or supply zone, price or liquidity gets taken out as it's going down or as it's going up, right? Depending on the trend. But that is essentially as easy as I can put it for internal and external liquidity. So let's move on. Okay, so identifying the momentum or shifts in the trend. So for momentum, we are going to mark out your recent high and low areas where price pulled back and caused a break of structure. Then you will ask yourself, is the trend currently bullish or bearish? And then finally, I want you to map out your trading range. Now I'm going to show you how that looks like on the charts real quick. So real fast, this is how I would map them out. So from here, I would start right here all the way to that high, right? And use the trading range. Okay. And then same thing here from this low, higher low, all the way to this higher high. And then same thing here from this low to this lower high. So generally I would say, and this is on the 4 hour, by the way, generally I would say overall we are bullish. Okay, so that is how I would map out my trading range. Now you can also do this on any time frame. It works on any trend, and this will usually give you a really good indicator of whether price is currently bullish or bearish. And if you want to copy my settings, which I have linked this indicator in the presentation so you can download it. But yeah, these are the settings that I use for this higher low indicator. You don't have to use an indicator if you don't want to. I just like using it because it gives me a pretty good general idea. Okay, so let's move on with the next part. Okay, so for shifts, number 1, has price taken out a major low or high in the opposite direction? Number 2, keep in mind that the first major point could have been a liquidity grab, so unless it was taken out with great momentum, I wouldn't worry about it. Thirdly, if the second major high or low was taken in the opposing direction, then it's time for a shift in the market. In other words, make sure there are 2 new highs / lows have been formed or created. It just depends on the trend, right, that you are currently in. And number 4, you will continue to trade in the newly formed range until you see it has shifted again. This applies to any time frame, but let me show you a quick example. Okay, so for this first example here, we have the Dow Jones on the 8-hour time frame. So as you can see, we were going pretty bullish, right? We have a break of structure towards the upside, but then all of a sudden price takes out a pretty major low, causing it a change of character or a possible change of character. Then what does price do? Price creates a pullback and then finally breaks another major swing point towards the downside, confirming our shift in trend. And here, as you can see, price was pretty bearish and there was a break of structure towards the downside. Then what does price do? Price, instead of creating a pullback, it takes out some structure, some major structure points towards the upside, right? Towards this major high. And then it takes out another high from over here, right? Finally creating a pullback and then continuing back up towards the upside. Okay. And what a lot of people seem to do is as soon as they see the first break of structure towards the opposite end, they typically like to get on an area of supply or demand, depending on the trend, and then they continue to trade going down. I don't recommend that, but a lot of people seem to do that, and it may or may not work out. It's up to you and how advanced of a trader you are. I do that, but not very often. It just depends on a few other confluences, but it can work. It's just pretty risky. Okay, so I want to talk about these 2 very confidential little tips that I want to show you. I think they're pretty interesting and pretty cool, and I'm pretty sure you're gonna like. So let's hop on the chart example real quick. So for the first example, you can draw a area or your range right from the bottom of that high or low, depending on where you're at on the trend, but for instance on the 4 hour, and I recommend you do this on a higher time frame. It can be the 4 hour or anything higher, and you should draw from the bottom to the top. If you are finding pullbacks, right, going bullish, obviously from the bottom to the top, and if it's bearish, from the top to the bottom. And you keep doing that until you get to the end of your range, or you can just do it simply on the end of that trend range. So from here, I drew my trading range, my bullish trading range from the bottom to the top, And then I drew my trading range, my bearish trading range, from the top of that same wick to the bottom of where it first started. Why? Because I can drop down to a much lower time frame, let's say the 5 or the 1 minute or even lower, and counter trend trade, right? But as soon as price gets to at least the 50% area or the equilibrium zone of that trend that I marked out on this blue area, I will stop counter trend trading because price could reverse at any moment. Now, generally, you shouldn't really be counter trend trading, but if you are, this is a very great way to do it. Okay, so I thought I would show this to you guys. Maybe you might find it pretty interesting. It's up to you. Now for the second little confidential tip, you can mark out your trading days. So from Monday to Friday, and on Tuesdays on the 1 hour, from the lowest point of Tuesday and the highest point, you mark them out. And if on the 1 hour a bullish candle or bearish candle, it just depends again on the trading range. In this case, if a bullish candle breaks above your Tuesday high, the rest of the day should generally be bullish, or the rest of the week should generally be bullish, right? And then vice versa, if let's say a bearish candle body closes below the Tuesday low, then generally the rest of the week should be bearish, right? So you can actually decide to trade depending on where that candle broke. So again, if let's say price broke towards the upside with a bullish candle body, you can say, you know what, I'm going to look for buys for the rest of the week, right? Maybe you can look for buys on the 1 minute or the 5 minute time frame. And same thing here, price closed bearish with this candle, and you could have set up a supply zone here and then wrote it down to here for Wednesday, and then another supply zone up here, and then wrote it down for the rest of the day or the rest of the week. It's up to you. But I just thought this was pretty cool when it was shown to me. And yeah, you know, give it a shot. Yeah, I'm not saying this works perfectly 100% either. This is not a 100% fail proof system. I just thought it was worthy enough to show it to you guys, and maybe you guys could do something with it. So yeah, let's move on. Alrighty, so let's talk about optimal trading conditions based on probability. Now, you don't have to listen to this part if you don't want to, but this is just something that I have found generally from my trading experience and from the trading experience of others, right? So for Monday, avoid trading during the London session. Reserve trading activities for the New York session only if an A+ setup occurs. Mondays are typically used for chart preparation for the week ahead, as well as accumulation. So price typically tends to accumulate a little bit on Monday and then continue to expand or whatever it wants to do for the rest of the week. Now, Tuesday, regarded as the prime trading day with the highest potential. Hold swing positions until Thursday's New York session if that aligns with your trading style. So if you were holding a position from Tuesday, or if you entered a swing position on Tuesday, it's generally recommended you just hold it until Thursday. Tuesdays often offer the best opportunities, presenting the main swing for the week. Wednesday serves as a pivotal day, potentially signaling reversals or continuations from Tuesday's movements. Considered the third best trading day in terms of opportunities. Thursday commonly marks a reversal of Tuesday's trends, initiating movements for the following week. It ranks as a second best trading day, providing substantial opportunities. And Friday, restrict trading activities to the London session and New York session. You can still trade London session, but I still would recommend it. For entries taken during the New York session, close positions by the end of New York 5 p.m. That's Eastern Standard Time. Fridays are generally deemed as the second least favorable trading day. And please don't trade red folder news, not unless you know what you're doing. Now, I will say this, guys. Like I said, if an ape setup occurs, you can go ahead and trade those supposed non-tradable days. I generally try to keep off of those days, but every now and then I will enter a setup. Even during news, I don't really like trading news that much, but if there's just a really good setup, I have to get in. I mean, come on, that is just money ready to be made. But again, don't do it if you don't know what you're doing in this market, okay? You're a newbie. If you're a newbie, please stay out of it. Just trade the days I'm recommending you here. All right, so let's continue. All right, so high probability confluences for any trading plan. So you can use these confluences when you're trying to build a trading plan or a supply and demand trading model. All right, so identifying the trend. Never trade against the trend unless you are a seasoned trader, and even then, very few professional traders trade against the trend. Next, supply and demand candles. These are the candles or candle that causes major market impulse, as well as the candle that comes before a fair value gap and can be used as your demand / supply zone. Actually, I want to show you on the chart real quick how that looks like and maybe clear up a few misconceptions. Okay, so let me zoom in. So as you can see, I would consider either this my demand candle, and let me change that to make it more visible, right? Either this little one right here, because this is the bearish candle before our bullish candle, or you can also choose this one, since this is the one that's before our gap here. Now, something that I also think that people seem to have a little bit of a misunderstanding, or I guess just something that I should clear up because it wasn't necessarily taught to me at first. Even though you are looking for a demand setup, you can use a bullish candle as your demand zone, and you can use the bearish candle as your demand zone, and vice versa. Right? It doesn't have to always be the bearish candle before the bullish candle before the bearish candle when it comes to looking for your supply zones. It can be whatever you think makes sense. Sometimes that means even this candle right here, right? Because on a higher time frame, these two consecutive candles means it equals one whole candle on a higher time frame. So you could also use that as part of your demand or supply zone, obviously depending on the trend that you're in. And that is one way that you can actually avoid not getting tagged in, right? So let's say price comes down near this area and then you realize that, oh, it doesn't tap me in here, right? But you go on the higher time frame and say, oh wait, these two candles make a whole order block, and price actually tapped into it here, right? So you can actually cover the rest of this zone and then you'll be good to go. Now, another thing too is you don't want to maybe expand it too much, right? Maybe you don't want to get in too early. You want to get in on a really good deal, but you're afraid of still getting missed out. What you can do is actually bring up your demand zone to that fair value gap, right? So you can actually place it here, and price, once it comes down, it'll tag you in and you won't have to worry about missing out on that trade, right? So same thing here, right? Let's say you're up here, you're trying to get that bearish candle, okay, but you're afraid of missing out because there's this gap right here, and you're like, you know what, I'm afraid of not getting tagged in because this gap's pretty big. You know what, I'm just gonna draw it from here. Well, I'm gonna draw my demand zone, my supply zone from here to that gap, covering that part of the gap. And guess what, you could still get in at a really good price level and then continue to write it down, right? It's all up to you. These are just a few little things that you can try to mitigate those losses of not getting tagged into a trade. Just a few little tips or tricks that I've learned along the way. Now we have imbalances. So you don't always need to have an imbalance near your zone, but when it does, it makes it so much more powerful, especially on the lower time frames. All right, so I already touched up on this, so you should be good. Next, liquidity. Things like equal highs, equal lows, trend lines, buy side, sell side liquidity, internal, external liquidity, etc. If you don't have a good idea of what this is, then take a look at my video on this. And like I said, take a look at the liquidity and inducement video because it's extremely important. Now, You don't need to have every single little confluence to enter a trade, but it's so much better if you do have it. And actually, I have an example here, or a few examples of what it would look like if you had everything, right? So let me zoom in. As you can see here, a little bit, there's a gap here, there's my demand zone here, price taps into my demand zone, and guess what? You could have had your first take profit here, your last take profit here. There was some liquidity being formed down here, and some external liquidity being formed down here, or out here in the outside, right? Sometimes you'll have internal and external liquidity. That's just how it would look like in a bullish scenario. Now for a bearish scenario, again, you have a fair value gap down here, pretty big gap, my supply zone up here, some trendline liquidity, price builds up, taps into barely my supply zone, and I write it down to the fair value gap. Now, this is something I also recommend people to do as newbies. Sometimes it's better to just target stuff inside of your range, right? Sometimes it's not always best to target all the way to the bottom of your trading range. Sometimes it's best to just target that gap. I mean, look, price barely taps into my gap, and for all I know, price reverses to all the way to the upside, which I think it actually did. So it's just something, or little things to keep in mind, or at least take a good bit of partials out. Do whatever you have to do to keep as much money as you can, and to be careful. You know, if you don't need to hold your trade for all these excessive risk to reward movements, don't do it. It's better to have a pretty decent strike rate and a pretty decent risk to reward and make profits consistently, rather than just messing with your psychology, because this can take a toll on your psychology. If, let's say, you targeted all the way to the bottom and you didn't take any money out, and then price reverses on you and you lose, it's gonna take a huge toll on you. I promise you. Don't do that to yourself, especially if you're starting out. Okay, so just thought this would, you know, help out a little bit. But yeah, definitely test this out on a chart. Okay, now let's move on. Next, we have the pairs that I recommend you to start with. So after you have mastered at least one of these pairs, then you can trade whatever your heart desires. So for Forex pairs, I recommend you start off with either GBP USD or Euro USD. If you like trading commodities, something like gold, US oil, or the gold versus the euro, I think that moves really well. But yeah, if you want to trade commodities, this is what I would recommend. For indices, S&P always, NAS 100, and US 30. I recommend US 30 over NAS 100, but that's just my opinion. But yeah, I recommend you just start off with one of these. No need to go crazy on all of them. All right, master one and do it. And for Forex pairs, I definitely recommend the euro over the GBP USD one. Yeah. Now, taking partials and moving your stop loss, make sense of it. When taking partials and moving your stop loss, make sure you're doing it in a strategical manner, because you can get stopped out early and miss out on some money. Furthermore, make sure it's part of your back-tested data. Reason being is because there can be times that where you lose more money than what you're actually protecting, and it can be because it's not supposed to be part of your trading plan. A lot of people seem to never factor this in. Don't move your stop loss if you're not supposed to. Don't take partials if you're not supposed to. Make sure that the amount of partials makes sense. Make sure that it goes along with your risk to reward, with your strike rate. It has a lot to do with it. You have to back test your strategies. That's why I emphasize back testing so much. Okay, so let's jump on the charts and let me show you a strategical way of moving your stop loss. So one way that you can move your stop loss, or when you should move it, is, let's say you enter into this long position. Right now, let's just say you already have a target for this position here, and let's say you have a higher time frame order block, or there's somewhere up here, there's like a last liquidity point that you want to target. Right, this is your last one right here, somewhere on the higher time frame. Again, I'm just making this as I go. Before moving your stop loss, you could say, oh, I'm going to move my stop loss now that price has finally reached this area up here. I wouldn't wait so long either. Why? I already had this structure break towards the upside. So what does that mean? That means that this should now be an order block. So if this should now be an order block, that means that it should be an area of protection, and if it fails, that means price should start reversing on me. And if price reverses on me, the last thing I want to be in is in an area where I'm going to lose money. So what you can do is, after price breaks this high right here, let me make it a little bigger, you can finally either move your stop loss to this new order block, or you can take out some partials or a good bit of your capital out of the trade, and then you can either move your stop loss or not, right? So but once price breaks through here, I would take some money out, move my stop loss to this newly formed demand zone here, and then target either my last set of liquidity here or this set right up here, right? And then once price breaks this major swing point, this major area, then I will move my stop loss to break even. But what I will not do is trail it. Why? Because at any point price could have done this here, like that, or here, right? At any point that I was moving my stop loss and trailing it, right, price could have stopped me out and then kept going up. Imagine if I would have moved my stop loss around this area. Imagine if I would have moved it around this area as soon as price broke this high right here, right? Imagine if I would have moved it up here. I would have been stopped out, and then I would have missed out on this set of liquidity. That's why I don't like trailing my stop loss that way. If once I move my stop loss to break even, that's it. I'm not trailing my stop loss. That is as far as it will go. Make sure there is strategy in what you're doing. Use price action to your advantage. Use market structure to your advantage when moving your stop loss. Okay, don't just move it just to move it. Make sure you've already back tested your model and your trading style. Okay, so without further ado, guys, thank you so much for sticking to this part of the series. I know it's pretty long for some of you people, but if you can, go through it, ask me questions. Please ask me questions. I want to be able to add more stuff to the Q&A. And again, this will be part of my Discord. If you haven't already joined my Discord, join it. I actually had a guy pass a challenge with the signals that I was sending. So if you haven't already entered, join. The signals are for free, at least for now. Take advantage of those signals, and I'm pretty sure you'll be surprised on what you can find on there. And yeah, guys, hope you have a good rest of your day. May your take profits be blessed, and I'll see you all in the next one. Peace.